And we have another day of trading underway on this Thursday morning. We saw stock futures coming under some pressure here for the first time in about 4 days. Looks like the Dow Industrials are going to start the day down about 90 points. Let's bring in Mike Ryan. He is America's CIO at UBS Wealth Management. We also have with us Jared Blickery and Brian Sozzi. Good morning to you all. Mike, I'm curious what you think the market, what has been driving this market lately, because it doesn't look like it's been the pandemic or the civil unrest we've been seeing in this country. So what's sort of been driving the momentum?
Well, first of all, Alexis, if you think about it, since March 23rd, the markets have kind of pivoted, and we've seen markets are up. The S&P 500 is up almost 40%. And I think a lot of people are seeing a disconnect between what the markets are doing, what the real economy is doing. But I actually think what you're seeing is the markets are actually reacting rationally. And what they're responding to is this extraordinary policy deployment. So think about this, between what the Fed has done and what we've seen elected officials do through fiscal policy, this is the largest mobilization of government resources, certainly since the Second World War, and arguably ever in peacetime. So that combination of just extraordinarily accommodative monetary policy and increasingly muscular fiscal policy is allowing people to sort of look past this sort of void we're seeing right now in terms of the pandemic-related downfall in the economy and that bridging process that we see into 2021. So I think we're looking through this year in terms of both the economy and earnings and into normalization in 20 and 21.
Mike, it's not just the U.S. With fiscal stimulus, monetary stimulus. Look what the ECB did this morning. That is just extraordinary policy. And do you think that we were asking a lot this week, is the market overvalued? But in light of this stimulus, do you think the market is undervalued? And we could appreciate 10 to 15% into year end, even despite all those things we're seeing in the country and even with COVID?
Look, there's certainly prospects that we could see a further melt up in markets. I certainly wouldn't be dismissive of that. But I would make the argument that markets are now undervalued relative to what we've seen in terms of both the policy measures and where markets are repriced. I think the markets have accurately reflected the extraordinary policy reflex response we've seen, again, both by central banks and federal government. I think what's going to be required now for markets to continue to grind higher is we are going to have to see some progress on three fronts. One, we are going to have to see that the war against pandemic is yielding some meaningful and sustainable results. In other words, that we've not only bent the curve, but we're actually starting to see that the caseloads continue to decline. So that's one thing we're going to need to see. Secondly, we need to see that there was enough of the commercial infrastructure that was preserved through this dark period that the economy restart can happen quickly enough. One of the concerns we always had was that when you have these kind of shocks, unless you have a massive policy response, which you're going to wind up seeing, is a concern then that you destroy a lot of the commercial infrastructure. So the view here is that I apologize for that dog in the background. You can tell we're all working from home now.
I thought that was my dog for a second.
So the issue here is that we need to see the economy is going to work through that transitional period. And maybe the last thing is, I think we are looking also for some pharmacological progress.
I think your dog is agreeing with you, Mike. That's
dog's bullish.
I'll tell you, that little dog doesn't agree with you very much, Alexis.
It's okay. We've had babies crying and dogs barking, so that is a symptom of working from home. Where are you putting client money to work right now? I mean, is it primarily in U.S. equities, and if so, what sectors?
Well, first of all, we are actually taking an approach where we do have exposure in credit as well. We think that the equity markets probably run ahead of the credit markets, and that we do see some opportunities in credit, both investment grade and high yield. In terms of our sector positioning, we've actually increased our cyclical exposure, because while the market has run higher, there have been some laggards, and we think there's going to be some catch up now. So we do have a moderately cyclical bias. The three sectors we're focused on right now is going to be communication services, it's healthcare, but also industrials. We just recently upgraded our industrial exposure. So again, it's a little bit of a mix between defensive and cyclical, but we're coming increasingly cyclical. And we also have a preference for mid-cap stocks in this environment.
All right, Jared, I want to get over to you. Before the opening bell, we talked about how the 4-day winning streak for the market was in jeopardy. What do you see moving us early here in the morning?
Well, we have discretionary. Consumer discretionary is the only sector of the 11 in the S&P 500 in the green right now. Outperforming is staples, also in materials and industrials. That's a continuation in terms of industrials and materials over trends we've seen over the last few days. The laggards, real estate, energy. We have crude oil down about 1.5%, despite OPEC, at least the Saudis and the Russians, agreeing to extend the production cuts for one more month. But just looking at the NASDAQ heat map, we can see FANG stocks, the big cap stocks, under a bit of pressure, except for Amazon. That's carrying the discretionary sector. Sorting by performance, we're going to see some travel stocks up there. The airlines are really catching a bid this morning. China is going to be reopening U.S. flights with China, not only for their own carriers, which they've already done, but ours as well. And also the federal government is easing some of the restrictions on the travel on the airlines in terms of the points that they have to serve. So in other words, they're going to be able to cut some costs. But it looks like the chip stocks kind of underperforming. Broadcom here, we see it down 2%. That is the laggard in the in the NASDAQ 100. They reported earnings after the bell yesterday. Microchip down as well. Even Zoom Technologies it's down today, still up 6% over the last 5 days, and year to date still up 223%. But just looking at the sector action, once more we can see industrials, discretionary materials are in the green right now. And I just wanted to point out something kind of bigger picture. We have this interesting stat that comes from LPL Financial. We are on the best 50-day rally ever. All right. And so what does that mean going forward? Do we get a sell-off? Actually not. Going 3 months, 6 months, and 12 months, the outlook looks pretty good. The median return over 3 months is 6%, 6 months is 9%, 12 months is 19%. But as I said earlier, kind of taking a pause here after we hit that resistance level on the S&P 500, Alexis.
Mike, you just heard what Jared was saying. The market, no surprise to you, I'm sure, is in major rally mode here. Do you think what we're seeing on the street is fear of missing out?
I think that's a bit of it, Brian. Remember, we're seeing this massive rally, but it comes off to an extraordinary sell-off. You think up until March 23rd, this was the most significant and sustained accelerated sell-off we've seen in history as well. So it's not terribly surprising that we're going to get a fairly sizable bounce back from here. So I do think what you are seeing now is that there are some people who have been caught off sides here, people who are looking for perhaps that we'd see a secondary outbreak or that the impact of the pandemic on the global economy would be sustained for a longer period of time. So I think there's been some unwinding of that initially. I think what you are starting to see now is people who thought that the recovery would play out in a much more methodical fashion, people who were sort of waiting for entry points and now being forced in. So you're starting to see increasingly now that people are looking at, looking through again this transitory period and focused on what we'll see in 2021 and 2022. So to me, I think there is a little bit of this anxiousness right now of people who missed the first part of this route on the sidelines for us.
Mike, tomorrow we have the May unemployment report. It's going to be a market-moving report, and we're expecting another horrific number. But is the market basically discounting this now because economies are starting to reopen? It is such a backward-looking number.
Yeah, Alexis, I think employment reports are always important. If you go back, I would argue it's probably one of the most important economic releases we get each month because it's relatively comprehensive and it gives you a snapshot of things that are happening in terms of demand for labor and also in terms of what's driving the economy and also cost. So it is a pretty comprehensive measure, and it's one that's also tends to be relatively timely. I think we have to take most of the high frequency economic data we're seeing right now with a bit of grain of salt because the facts on the ground are changing so quickly. And as you just mentioned, it is backward looking. And what we're seeing right now is the pandemic slowly unwinds, and as we start to see the reopening, the dynamics in terms of the economy are changing so quickly that you can't capture that with monthly employment data.
If Mike, do you think if the headline number comes in better than expected, the market does rally? And I ask that because we've seen a stretch over the past week and a half where economic data has come in much better than a lot of people expected, and that has been the fuel to this rally.
Yeah, I think you're right, Brian. First of all, look at what we're seeing in terms of the ADP numbers, the ISM numbers, and certainly even the personal income numbers. When we saw above consensus reads there, what you saw was as a response. Again, there had been this expectation that this recovery process was going to be a long, drawn-out affair, and that it would happen in incremental doses. And what you are seeing is the quicker there's a bounce back, people are starting to talk less and less about L, and even more or less about U, and perhaps even that this may be a really, really deep V recovery where things bounce back much more quickly. And I'll go back to one of the things I said before, Brian. Part of what allows for this recovery was preserving the commercial infrastructure. And I can't emphasize that enough. One of the worst things that could have happened is if policymakers had done nothing. And what we would have seen then is we would have seen bankruptcies, defaults, we would have seen liquidation of assets, we would have seen business failures. And then to restart the economy is incredibly difficult because you have to go through the process of new business formation, raising capital, establishing credit lines, entering into contracts, hiring workers. That takes an awful long time. So the more of the infrastructure we're able to preserve, the more of an economy there is to bounce back as we reopen. I'd also argue one other thing that's probably constructive here, which I think people didn't appreciate early on, was the fact that this economy has a staggered story, that we're not trying to reset everything at the same time. What we are seeing is regions that were less affected are starting earlier. And that's important because we're getting critical information about what works and what doesn't work. And that information can be applied across the rest of the economy. So that real-time processing information means we're finding out that there are certain types of businesses and services we can open earlier than we would have thought because the infection rate is not spiking in those instances.
All right, Mike Ryan, America's CIO at UBS Wealth Management. Pleasure. Thanks for being with us.
Thanks, Alexis.